I'm selling very short dated options, 1 days to expiration and 0 days to expiration. We're talking about some pretty serious money.
Selling naked puts on SPX, which has a lot of value. It must take a lot of margin.
Too much. So that's why it actually took me until the very ripe age of 44 to then retire. Sometimes you hear YouTube influencers and they say, well, with my option trading strategy, you can do 50% a year or 70% or 120% a year. So that's not what I'm doing.
The FIRE movement, financial independence, retire early, has become increasingly popular. But how can options trading be used to boost a FIRE portfolio for someone who like to retire early? My guest is one of the most respected voices in the FIRE community and a numbers-driven options traders with years of experience. Welcome, Karsten Jeske from the blog Early Retirement Now.
Thank you for having me on the show. Thank you.
So we will dig into the details of how you trade options and to boost your FIRE portfolio. But first, give me just a 40-second version of what it is you're doing.
Right. So I'm selling very short dated options, 1 days to expiration and 0 days to expiration. So I do the 1 day to expiration put options. So I sell at the market close for the next day's market close. And then at the market open, I usually throw in another several puts and also short some call options intraday and target very little premium, something like 10, 15, 20, 25 cents each. Very small premium, but over the whole year, it's actually accumulates quite a lot of revenue for me.
And you've been doing this for more than 10 years with very good results, isn't that so?
Right. Yeah, I started this in 2011. Obviously, the market environment has changed a little bit. For example, I think in 2022 is when we started to have all 5 days expirations, right? So it started with just Monday, Wednesday, Friday. I might have even started only Friday options, and then the Monday and Wednesdays came in, and then more recently the Tuesday and Thursday expirations came in. So that has changed over time, but the general idea of this strategy has not changed. Sell as short as possible, as short dated options as possible. Have as many independent gambles throughout the year and average that out, and the results have been pretty good.
I really look forward to dig into the details of how you trade. But Karsten, first tell us a little bit about yourself and what you do.
Right. So I'm retired already. So I retired 7 years ago in 2018. Before that, I worked in economics and finance. So I worked in all sorts of different jobs in academia for the government, Federal Reserve, as an American central bank. And then my last job before retirement was worked in asset management for a big corporation, Bank of New York Mellon Asset Management. Made very good money, and but then in 2018, I realized I had enough money to just retire at that point. And then since then, yeah, I've been retired, but staying busy, right, with my option trading. Even though that doesn't take too much time, it's not like a day trading job. But yeah, apart from that, I have a blog. I still do a little bit of consulting, so I try to stay busy, but it's not as busy as with the real corporate career that I had before.
Tell us a little bit about the FIRE movement and what attracted you about it.
Right. So FIRE movement, as I said, financial independence, retire early. So the idea is that when you're young and middle-aged, you save more or less aggressively. Some people take this a little too far and they become overly frugal. I've never been that. I've always lived quite comfortably, didn't constrain myself too much. So that's why it actually took me until the very ripe age of 44 to then retire in 2018. And some people retire much earlier than that. So some people as early as their 30s. So they accumulate very aggressively. And then once they realize that their passive income potential from their nest egg is enough to cover all of their expenses, then they retire and enjoy life. So, I mean, and this is obviously different for everybody in the FIRE movement. So I like to spend more time with my family. We travel very aggressively. So we have a daughter who is school aged, so a little bit constrained because of that. But so summer break and winter break, we're traveling. We're trying to travel probably around 10 calendar weeks every year. 10 to 12 maybe even. And then we also have a lot of extra bandwidth to do other fun stuff, right? I mean, we volunteer a lot at my daughter's school, at church. Fire gives us the time and the bandwidth to be able to afford that. It's actually, that's really an ultimate luxury. So lots of people have a lot of money, but very little time. So we actually have pretty decent sized portfolio, and then also a lot of time to be generous with our time to spend with family and help others. I was concerned, well, could I be bored in retirement, right? And I don't think I've had a boring day in my life. Maybe the option trading is part of the reason for that. That's a lot of excitement on every trading day.
How common is options trading in the FIRE community as one way to build or boost the portfolio?
Right. So, funny thing is, I don't think it is very common. And probably the reason is that the main influencers in this space tend to be all these very passive investors. Basically, you've probably heard about the bogleheads, right? So people say, well, the reason why this whole accumulation into FIRE works is it's not because you're a stock picker or a market timer. Everybody can do it, and you keep everything very simple. And so because of this, everybody wants to market FIRE as something very automated and simple, where everybody can do it and it doesn't take any special sauce and special skills. So people are probably a little bit hesitant to try anything different from that. But I'm obviously trying on my blog to market some a little bit more non-standard strategies like option trading. But again, my main portfolio is also very passive, right? I have my passive S&P 500 index funds, and is only that on top of my existing portfolios. That's when I do the options trading on margin.
So we will dig into how you trade. And I just wanted to remind that you actually have written very detailed about your trading strategy on your blog, Early Retirement Now. So for anyone who are interested in studying it even more than we are able to do in this short interview, I do recommend to go to Karsten's blog. But before we go into the detail, what are you trying to achieve with your options selling strategy?
One of the challenges, obviously, in not just early retirement but any retirement is, right. So it's relatively easy to accumulate money and just set this on autopilot. But then when you withdraw money, you face this risk that if you retired at just the wrong time in historical retirement cohorts, there's some simulations where people look at, well, how would different withdrawal rates have done in historical retirement cohorts. So there would have been some cohorts where, say, withdrawing 4% out of your portfolio and adjusting this for inflation every year, you would have actually depleted your portfolio, even though returns in the stock market, right, they tend to be something like 6-7%, maybe even more than 7% annualized for adjusted for inflation even. And how is it possible that sometimes you run out of money with the 4% rule? Well, if you have very bad returns initially and you take money out of your portfolio while prices are very depleted, well, the stock market will recover, but your portfolio is so depleted from your early withdrawals that your portfolio will never recover and then eventually run out of money. And what the nice thing is that if you could have this extra cash flow from your option trading, you will then relax the constraint on your portfolio during these very volatile markets. If you have bad luck and you have a recession and bear market coming right out of the gates in your retirement. So I think this is actually a beautiful strategy to complement your FIRE portfolio. Even if you squeeze out only 1 or 2% extra out of your portfolio. I mean, think about it, right? You have maybe without option trading, you would have budgeted a 4% withdrawal rate, but with option trading, you can do, say, 5% or 6% withdrawals. I mean, that's a 25 or 50% increase in your retirement budget, right? And just squeezing out even a few percentage points out of your portfolio with option trading and this extra cash flow is going to be hugely beneficial for retirees. And then on top of that, obviously, Well, you're early retired, you have some extra bandwidth, so you don't mind doing a few trades at the open and a few trades at the close. It's not like it's not a day trading job. As a want to emphasize, I don't have to be in front of the screen the whole day. I can finish my trades within a few minutes, both at the open and at the close.
So let's get into your options selling strategy on SPX. You are selling naked puts
Right.
on a daily basis. So please describe in a bit more detail what your strategy is and what you
Right.
do.
I mean, it's very simple. I at the close, I sell put options for the next day. So, for example, we are recording this over the weekend. So on Friday, S&P closed at something like 62.38, and I sold a bunch of puts with a strike of 5,700, and they fetched a premium of 20 cents. So these are the Monday put options that expire on Monday at the market close. Have a certain risk budget, right? So I don't max out all the margin for the overnight puts. I keep well more, probably about 2.5x the margin that I would need. But so it's a relatively small premium. People would say this picking up nickels in front of the steamroller, but been very lucrative through all market environments, very volatile and not so volatile periods.
But you said 20 cents, which means you are far out of the money.
Right.
And are you aiming for a specific delta or a specific credit, or how do you determine what you will sell?
Yeah, right. I usually look at the premium. So I target a certain premium. I have a risk model where I can basically calculate what is the expected loss at different strikes. So, and I basically look at, these are the premiums. This is what I would have to subtract as my expected loss. And then I look for basically where are the sweet spots. So it's not a fixed premium. So the premium, sometimes I feel comfortable selling up to $1 premium or more. And sometimes I am so risk averse where I do only 5 cents or 10 cents premium. But so for the most time, so this year, 2025, year to date, I think my average net premium after the commission was about 17 cents. So the average and the average premium must have been just under 20 cents on average, and then you take off a little bit for the commission, and that's how I ended up at 17 point something cents. And it's also the same as last year. I think I had also a 16 or 17 cents premium on average for all contracts, for the overnight contracts.
And you measure just about everything about your trading, as I understand it. What average delta do you typically end up with?
My deltas are actually below 0.01 most of the time. Most recently, the average delta for the overnight puts is something about 0.3 times 0.01, so 0.003. So it's a very, very small delta, very small probability of going in the money. And so, for example, in all of 2024 calendar year, I had zero losses on my 1 DTE puts. This year, I've had two very small losses, and it's not because the puts went into the money, but I liquidated the position a little bit early when things got a little bit too dicey. So very high conviction trades that very high probability that I make that premium.
But Karsten, selling naked puts on SPX, which has a lot of value, it must take a lot of margin or buying power,
Right.
doesn't it?
Right. So most recently, I think the initial margin is about $63,000, $64,000, $65,000 for one short put overnight. So at least in the range where I'm selling. And so that's the minimum margin. And I actually keep more margin than that. So I think I have about probably about $160,000, $170,000 in capital for each of my short puts. So I keep well more than the minimum margin for that.
But is it worth it to spend to have like a margin of 60,000 for making 20 cents.
Yeah, it's $20, and it
Sorry.
doesn't sound like
Mhm.
much. But you do $20 and you do this 250 times a year, and every single day. So now we're talking about we're already making a return that's somewhere in the percents, right? This is no longer 0.0000%. This is now getting into the percents, right? So, and this is just the overnight puts. So I also supplement that with because as I said, as I explained earlier, I don't max out my margin overnight. I mean, first of all, I don't want to be that much leveraged overnight, anyways, because something bad can happen overnight. So I supplement the trades every day at the open. I fill up the rest of the margin with additional puts, so the zero DTE puts, and then also zero DTE calls. And then once you put everything together, you can get somewhere into basically the gross revenue where you can get into the high single digit percent. Right. And then, of course, every once in a while you have some losses. So my return target is somewhere in the neighborhood of maybe 4 to 5% of my actual portfolio, of my option trading portfolio, which is not my entire portfolio. Right? So I have currently about, I think, $2.3 million in that portfolio. Yeah, and you make an additional 4 or 5%. So we're talking about some pretty serious money. So, and this is in addition to the money that I have in this portfolio, which is invested in some stock and bond funds. And so that they also pay dividends and interest. So it can get very quickly generate pretty serious additional money.
So if I understand it correctly, this you have stocks, you have bonds, other assets that you are actually using to fill up the margin. So you look at this more like an add-on to the portfolio you already have.
That's correct. So this is because you trade these options on margin, right? So it's on top of the portfolio that you already have. And this is really the beauty of the option trading strategy that I propose. So imagine somebody came up with an ETF that replicated some option trading strategy. Well, the problem with that is you would have to take your portfolio, sell what you have currently, and then buy that ETF. And so it could have tax consequences, right? It would then have the opportunity cost. Well, you have to sell the equity and bond funds that you have, so you lose that income. So the nice thing about the option trading is that you don't have the negative tax consequences. You don't have to sell anything to do what I am doing. You can just do this on top of the portfolio that you already have. This is one of the ingredients for successful FIRE, right? I mean, you have your existing portfolio and then you add more return potential through the option trading. You don't take away anything from your portfolio, you just add something. So I love this approach.
Karsten, we need to get back to how you manage these trades and how you manage the risk if you use stop loss, etc. What are your rules for doing that?
So I have stop losses, and of course the problem is that overnight I don't do stop losses. So I basically I cross my fingers that overnight the market is not unraveling enough to already go into the money or gets close to into the money. So far, I mean, that has worked relatively well. But so for everything else, once the market opens, then I'll put on stop losses for both the overnight puts and then also the zero DTE puts and calls. And so, I mean, obviously, this is a bit of a fine line, right? Because the one DTE puts, you get extra premium for that, right? So I make 17 cents instead of 10 cents premium. But there's also the additional risk, right? What happens if there's any kind of gap risk, right? Where the market gaps down very substantially. I mean, so far, that has all worked out very well because I sell so far out of the money. I consider it relatively unlikely to go in the money. But again, it's possible, and it basically means that I can do as much leverage as maybe some people would like to do, right? So I don't sell, I don't say, okay, I have this much money in my account, I divide that by, say, $63,000, and this is how many puts I sell overnight. So I don't do that. Just to do the math here, right? So for example, if I have $170,000 of capital in my account, so that's 1,700 index points. So to wipe out my portfolio, the index would have to drop, first of all, to the strike, and then it would have to go 1,700 points into the money to wipe out my portfolio, which I think is kind of unlikely, right? Especially overnight, and especially if we are operating in basically the environment that we have right now, where the VIX is around 20. So it would be kind of sort of unheard of that that you would go that far in the money in an environment where the index is where the VIX index is at 20. So there have been some very steep losses in the S&P 500, obviously. So even more recently, we don't have to go back to all the way to 1987, where we had a 20% loss in one day, but we had a 12% loss in March of 2020. And of course, did I lose money on that trade? No, I actually made a ton of money on that day, because I'd actually sold 20% out of the money. So if the index dropped by 12%, I still wasn't even close to getting in the money. So yeah, I mean, it obviously takes a lot of risk management, and you have to be aware how far do you want to sell out of the money. And if you have some leverage, you definitely want to make sure that you have some sense of, well, how far can the market go, so you're not going to have a disastrous one-day drop. So.
And you have a very deep professional knowledge of finance.
Right.
But what about the rest of us who do not really have those abilities to do all those detailed risk calculation?
Right.
What's wrong with selling put credits but then defining the risk a bit?
Right. So, I mean, obviously, what you could do is, so instead of selling at, say, 20 cents and 3x margin, right? I mean, you could always do a 60-cent premium, and you do 1x. So you do zero leverage, right? So you set aside. So if you are selling a put option at a 5,700 strike, you should then have $570,000 in capital to hedge that risk. So even if the market were to go down to zero, you would not wipe, or you would then exactly wipe out the portfolio, right? So, but crossing your fingers that it's not going to fall from 6,200 points to 0 points in one day. One way to eliminate this black swan risk is to have no leverage, do exactly 1x, and maybe jack up the premium a little bit. So the advantage is you have less negative skewness risk. Of course, the disadvantage is that you have more likely a chance of the option going in the money, right?
We will get to your results. But first, I understand that you're also selling calls a bit.
I only started this about 2 years ago. And I was always pushing back because of two reasons. So I found it unpatriotic to sell calls, because then you kind of cross your fingers and you route against the market rising. So I found that quite suspect. And then obviously the moneyness is what I call it. So how many points you can sell out of the money, say for a 10-cent premium, is much less on the call side. So just to give you some examples, I think on Friday we had a very volatile market. On Friday was August 1st, and I sold the put options 260 points out of the money, and I sold the call options at 160 points out of the money. So there's less room for error on the call side. But then at the same time, market moving up, it's often not quite as rapid. The move up is usually a little bit more civilized. I mean, they say the market is going up, taking the stairs, and it's going down, taking the elevator. But yeah, so I also sell the call options, and it's a little bit of extra money. It's not my bread and butter business, but I think it supplements what I'm doing with the puts. Yeah.
You said you are using stop loss for the overnight puts, and that you're putting them on in the morning. What level are you putting your stop loss on?
And that varies. I have set the stops as low as, in fact, I've killed positions when the price went to 30 or 35 cents. And I have sometimes set the stops at something like $2 or $2.50. So it varies. Basically, I want to have basically a stop that wipes out maybe days or weeks. It shouldn't wipe out years worth of premium. So I'm happy. Um, Maybe wiping out a few weeks to maybe a month or two of premium. And then on top of that, right, is also depending on how I feel that day and that morning. So I might set it slightly differently. So I don't want to give an exact number, but it's somewhere between anywhere between say 30 cents and $3.
So you have traded this strategy for a very long time.
Right.
What can you say about the results?
So over 12-month rolling windows, depending on how well or not so well it worked, I think the worst 12-month result ever was $60,000, so 60,000, and the best result was $160,000. And then average has been something like $90,000 a year. That helps a lot in your retirement. It's not my entire early retirement budget, but if I take some of the other income from dividends and interests in my taxable portfolios, it's enough for me to just purely live out of that taxable portfolio without touching any of the principal, without having to liquidate any shares, just living off of the cash flow. And then I have another portfolio which is about the same size, but that's in these retirement accounts, which in the US there's very little option trading you can do.
How much would this be in like an annual percentage of the capital you are risking with this strategy?
Yeah, so as I said, so currently that portfolio is in the neighborhood of a little over $2 million, so $2.3 million. It was a much smaller. And then basically what I did was actually the dollar amount of income stayed roughly the same, but because the portfolio grew, the percentage returns from just the option trading itself are a little bit lower. I think very early on when the portfolio was much smaller, and the portfolio was maybe only $1 million, and I was making $100,000, $90,000, or $100,000 from the option trading. I mean, obviously, so that's 10% annualized. And right now, if I make maybe $90,000 out of a $2.3 million portfolio, that's actually only quote unquote 4%, and which is again. So just putting this in context, right? I mean, sometimes you hear YouTube influencers and they say, well, with my option trading strategy, you can do 50% a year or 70% or 120% a year. So that's not what I'm doing. So most people in my space, they already have very substantial portfolios. So in the seven figures, so somewhere between $1 million and $5 million are people that I know run similar kind of strategies. And for them, you don't need a 50% return anymore, right? So you just want to play it pretty safe. Give me 3, 4, 5% extra, and that's already a huge boost in your cash flow and your retirement safety.
And we do have a graph here. What is this showing?
So here what I plot is only the 0 DTE and 1 DTE contracts. Now basically what I do is every day I check how much did I sell in premium. So this is already after commissions. The black line is the gross revenue that I made from selling the options. Then the red line is, so why is the red line flat and then it jumps up? So the red line, it jumps up if there's a loss. Say there's a stop loss that's exercising, or I end up in the money. And so it goes up every time I have a loss. And then the green line is the difference between the black and the red line, which is then my profit. This year was unfortunately a bit of a bumpy ride, and it's all blamed on April, which was when we had that trade negotiations disaster, and market going down by, I think, almost 20% top to bottom, and then jumping up by 9% in one day. And then so sometimes you you lose money on the downside, and then the market jumps up again, and then you lose on the call option. So there were some crazy days in that. This is the year to date until the end of July. So as you can see, I made a little bit more than $40,000, which is only about $6,000 per month. I make a little bit of extra money. I would sometimes sell some little bit longer dated put options. And then again, I do this as naked puts. So that would make me another maybe $1,000 a month. So on average this year, I've made about $7,000, which is actually a little bit less than what I've made in prior years. So these are 36 months of monthly P&L, and so this is the 0 DTE and 1 DTE, and then also I would occasionally do as far as 120 days, maybe even sometimes 150 days to expiration. So also very far out of the money puts. So this is including everything. So here, I think this is about maybe $7,500 on average. So it's about $90,000 on average over the last 3 years, and you can see. The prior years, it was very stable. And then 2024, the second half of 2024, you get some real blockbuster months with $14,000 and $13,000.
Karsten, you pointed out that option trading is not very common in the FIRE community. And I assume that this is not the strategy you would recommend to someone who's not very experienced in options trading. It does require a lot of buying power and risk management. So what are the strategies you would recommend to people who have not that experience, who wants to build up a portfolio for early retirement? Are there other strategies you would recommend?
Right. So, I mean, obviously, a lot of people dip their toes in option trading just as covered call strategies, right? So I think that would be a very nice strategy to begin with. And then, yeah, obviously something like a credit spread, because then you have a defined risk, and that's probably a little bit easier scaling it. Maybe do something like a credit spread, and it doesn't have to be the 0 DT or 1 DTE. You do something like a 1 week or 2 week or several week days to expiration. So to have less risk, and then also less screen time for you. So if this is something that you want to dip your toes, but then, I mean, obviously over time you might get the option trading bug, and you actually want to do this every day, because I think this is this great excitement. I don't even watch any sports anymore, right? I mean, this is all the excitement I need. Putting in the trades in the morning, doing limit orders, seeing exactly what is the right strike where I get the best fill. That gives me all the excitement I need, but maybe not everybody needs that in retirement, and then obviously pre-retirement, right? Not everybody has the bandwidth to trade at specific times. Even if you wanted to, you couldn't do this kind of option trading strategy. But there are some others that you can obviously dip your toes in with the maybe longer time to expiration and more defined risk budgets there.
Karsten, how would you, in a few words, sum up what we have been through? And I'm particularly thinking about who is your way of trading best suited for?
Some people would say that my kind of trading is really a catch-22. It's not good for anybody, right? So you already have to be rich to trade this, and then maybe if you're rich already, then you don't want to have to deal with the day-to-day trading. So maybe my strategy isn't for everybody, but I think it's actually great for the FIRE community, right? So you have a big enough portfolio that is actually worthwhile to trade this. And the additional income every day and every month and every year is because it is really very, very stable. I mean, you could see in the 36-month chart that I didn't have any losses, right? So this is all adding every month to your pot that you can take money out of. It's an ideal strategy for early retirees, right? You have a little bit more bandwidth, you have a big enough portfolio, and it's a great hedge for a sequence of return risk, right? And even with just a 1 or 2% extra expected return, is going to make a huge impact in your retirement safety.
Karsten, what are good resources to learn more, both about the FIRE way of thinking and options trading in that context?
I have a blog, earlyretirementnow.com. You can read up on that. I have a safe withdrawal rate series, which is my other claim to fame in the personal finance communities, that I think very carefully about how much money can you withdraw safely without running out of money, and how you can personalize that analysis to your specific parameters, right? Because different people retire at different ages, and they might have some supplemental cash flows from pensions and government pensions and corporate pensions later in retirement. How do you factor that into your withdrawal analysis? So I do a lot of that heavy lifting. I like a lot some of the podcasts that deal with early retirement. There's a podcast called Choose FI. They do a great job at looking at all the different facets of personal finance and financial independence planning. And so that's on the FIRE side. Yeah, on the option trading side, I mean, it's obviously your podcast I enjoy a lot. I don't really have a lot of books on option trading. So the one book I have is, I mean, this is a one-stop shop. It's a derivatives book by Whaley, which is outrageously expensive. I think this is something like $140, but that is the one derivatives book that has everything in it. And the other nice thing about that book is it has I mean, back in the old days, we still had CD-ROMs, right? It has a CD-ROM, and it has the option pricing package for Excel. So it has an add-in to very easily do all the option deltas, both for actual, say, SPX options, but then also futures options. Just that toolkit is already worth $140. I think there's a lot of free information out on the web. I mean, obviously your YouTube channel is one of the most respected ones. So.
Thank you very much. And I would, of course, be happy if people look up some of the other interviews we have done on different strategies. And I would mention one in particular. We had an interview with Christian Czernic from Germany, about his no-loss trades, and which had some of the same motivation for options trading, that he want to preserve and add extra income on top of an already existing portfolio. So check that out. Karsten, thank you very much for joining and sharing how you trade.
Okay, thank you for having me.